Hey there, everyone. Dave Keller here with Market Misbehavior. Welcome to Chart This with Dave Keller. It's Tuesday, March 31st. Bear market's over. We're back to a bull market. The major average is ripping to the upside, and that last sentence was said with a great deal of cynicism and sarcasm. I don't know if I can declare a bear market move or a corrective move over with one day. However, if you were paying attention on yesterday's show, we talked about the high likelihood of exactly this sort of move. We're one good headline away from a big rip to the upside. And as we talked about, bear market rallies are the three S's. They are sudden, they are severe, and they are seductive. They are sudden. They come out of nowhere, as today's upside move did. Number two, they're severe. They're not just gentle moves to the upside. They often have big upside moves. And as we mentioned, some of the biggest bullish days I've ever seen happen in cyclical bear markets. The third S, it's seductive. This tends to draw people in here. So I think the game at this point is to try to differentiate a V bottom, of which we've had many in recent years, versus a dead cat bounce, right? That sort of slang term for a quick upside move that ends up resolving to the downside. You don't have to look that far back in history to see previous dead cat bounces, right? Coming off the February 2025 high, we had a big move down in March. We broke below the 200-day. We rallied right back up to the 200-day. And then we rolled over and accelerated down into the April low. No guarantee that that's what's going to be repeated here, but it's hard to get too excited about a day like today. Great one-day move, a lot of moves to the upside, a lot of stocks having some decent gains today. Does that change the technical complexion? I would argue not yet, but we will look at the charts and draw some conclusions together if we can. We're live streaming, by the way, today on Facebook, LinkedIn, YouTube, and X. I appreciate you all that are tuning in live. I already see some comments coming around. I didn't wear a green shirt today. I really don't match my shirts to the mood, however, but I appreciate you paying close attention to the wardrobe. Hey, that's one of the stretch goals for market misbehavior. We get to the point that some clothing company wants to provide a wardrobe. That's one of those long-term goals. We're getting there, right? We're not quite to that point, but hey, every view and every like helps get us to that point. So keep it coming. And thanks again, those of you that are participating live on any of those live streams. You can put questions anywhere. You can drop a comment. I can see them here. I'll try to grab a couple questions as we go, and anything we don't get to, we will put in the mailbag. Friday, we're planning an all mailbag episode, and we love to answer one of your questions there. All right, so here's what happened looking at the major averages. A beautiful update today. We haven't had one of these days in quite some time, to be honest with you. And so the S&P 500 up almost 3% today, 2.9% higher to 65.28 and a half. Fantastic recovery from the weakness that we observed on Thursday and Friday of last week, the further weakness we observed yesterday. Of course, headlines coming out from yesterday's close to today's close, talking about the prospect of the conflict in Iran and the Middle East resolving more quickly than some have suspected. We'll see what happens there. I'm still very skeptical of some meaningful resolution, but we'll see what happens. There's been volatility in the markets. There's been volatility in headlines for sure, but we'll take the update. So the S&P moving higher, the NASDAQ even better, up almost 4% at the close. Both of those finished near the highs of the day, which is pretty encouraging. We didn't have like a fourth quarter sell-off. You often get that rollover in the last hour of trading. Didn't really get much of that. This is a pretty decent, strong finish. Mid caps and small caps, all to the upside, everything up in a decent way. The Dow, the worst performer, it was still up 2.5%. The VIX was down about 5 points. We talked about the VIX remaining above 30, and as at yesterday's close, we had closed just above 30. That for us is a big time red flag. The longer that the VIX remains above 30, it's just those have usually been pretty significant drawdowns when we've had a VIX sitting above 30, and certainly if it remains above there or accelerates much higher. Today's rally in stocks came with a much lower volatility rating. The VIX got almost to 25 today. So that's a pretty encouraging drop in the VIX. Still, however, a high volatility environment. And so that's what I would caution you. I mean, these are not, bullish readings just yet. That would be the VIX down below 20, maybe in the mid-teens would be more of a classic kind of low volatility uptrend. Today was just sort of a strong bounce, volatility receding, all true. Rates generally came down today, but it wasn't a huge move in the fixed income markets, to be honest with you. The TLT was basically flat for the day. That's a Treasury bond ETF. The 10-year Treasury yield finished today just about 4.3%. That's not too much off of where it was yesterday when we were around 435 at the close. So you're seeing rates come off a bit as bonds rallied slightly. But again, it was not much. The dollar index moving down a bit, but again, not a significant move. Today was really about equities, also about precious metals, by the way. And as you look at the commodity space, you can see gold regaining its mojo, the GLD up 3.8%, silver up 7.3%. So what's happening now is even though we often think about gold and in particular as a safe haven, right? It hasn't been the case, right? If you look at the correlation between gold and stocks, it's been relatively high here. Generally, there's actually a very low correlation between gold and stocks, which is one of the things that makes gold so interesting when you're thinking about a truly diversified portfolio. Low correlated assets are usually a pretty good idea because that means weakness in one most likely doesn't lead to weakness in the other, or some clearly definable relationship. It's a little more fluid. Today was basically a big spike higher in stocks, big spike higher in precious metals. So gold and silver, kind of a risk on trade, apparently. Now, that makes sense when you think about what's happened in the last 12 months, right? Through most of 2025, particularly off that April low, gold and silver outperformed and did even better in a primary uptrend while stocks were going higher as well. So, not surprisingly, that relationship remains pretty solid here. And what that means for me is, if you're concerned about stocks going lower, it doesn't seem like gold is a potentially great place to be hiding out and thinking of it as a safe haven. I think it still could make sense as a diversifier, but should I expect that there's an inverse relationship? Like, not really. That's not been the recent relationship. Bitcoin, I would, surprisingly, I guess isn't the word I would use, because I'm not too surprised, because Bitcoin has not been jiving with equities too much recently. But I would say, while cryptocurrency markets were up today, not big time up, right? This wasn't like a full risk on day where it looked like a bunch of flows back into Bitcoin. This is more of kind of a low volatility up day. So, the S&P and the NASDAQ outpacing Bitcoin on the upside today. Bitcoin, for what it's worth, in the upper end of where it's been this week so far. We're just above 68K. Ether prices right around 2,100. Most of the top 10 coins here in the green today. But not a real, if you look at the chart of Bitcoin, it's not particularly impressive at this moment. It's actually toying with what I would probably label as a bear flag pattern. I grabbed that chart just so we could look at that and see how it relates to, and I would say differs from, the charts of the S&P 500 and the NASDAQ. Looking at the 11 S&P sectors, pretty good day in terms of sector performance, as we're going to see in a minute. Pretty decent day for breadth as well. Sector-wise, technology back at the top with the XLK up 4.2%. Industrials, the XLI up 3.3%. Consumer discretionary up 3.1%. So strong moves. All of those sectors up over 3%. Tech, obviously, the big one. So if you think about what happened today in the markets and what happened with our benchmarks, the XLK is about a third of the S&P. We talked about that over the last couple sessions, where the indexes were down and technology was down. That makes a lot of sense, right? These are big names with big weights. It's the biggest sector by far. And so weakness there leads to weakness in the benchmarks. Today was about those beaten down names having big bounces higher. We're going to come back to technology in a second, because I have a chart of Microsoft I just wanted to talk about here before too long. But let's finish off this thought here. Only two of the S&P sectors were down, and utilities honestly were pretty much flat. So energy down 1.1%. So the market has essentially been the flip of this table here for the last couple of weeks, where energy's been like the only sector getting it done. The rest of the sectors were in varying degrees of flat to down. Here we're getting the opposite. All of a sudden, you're getting a rebound trade into technology, into industrials, which has been, we've talked about names like aerospace defense names, which had really good trends and then have pulled back in the month of March. You're getting those pullback names all bouncing today, and energy, which has been the strongest, now pulling back here today. So this is definitely a mean reversion of the trends we've been observing here in the last 6 weeks or so. This is basically the rebound trade with the idea that the conflict in the Middle East ends sooner. Any headline we get implying the opposite, that it's going to be more protracted. And again, I'm seeing plenty of signs that imply that is really probably the more likely scenario. Would not be surprised if this table flips, quite a bit before all is said and done. So nice rebound in some of those beaten down areas of the market. And at a high level, I guess I'll go here next. And thanks for bearing with me as I kind of whip around my normal strategy. Market Misbehavior podcast has been a lot of fun recently. We took a break last week for family vacation, but we do have an interview with Steve Suttmeyer, who ran the technical research department at Merrill Lynch and then became B of A Securities for a number of years. The Merrill Lynch technical research team, one of the legendary big technical research departments on Wall Street. And Steve ran it for a number of years. I've gotten to know Steve over the years and has a really good, consistent process of analyzing market conditions. Today, however, I interviewed, and this one's not ready, Ross Mayfield, investment strategist with Bear. This will probably be coming out to you after the Easter holiday. But I had a really good discussion with him about valuations, among other things. It was sort of a non-technical discussion. He pointed out the valuation on Microsoft, and I saw a headline on that earlier today. This is on Koifin. I just wanted to show you the forward piece. This is the next 12 months. So with PE, right, with a price to earnings ratio, two common ways to refer to that would be the trailing PE, or the last 12 months, which is basically looking at what you're paying today, the price, versus the trailing 12-month earnings. So what have they reported in the last 4 quarters? But what often makes a lot more sense for investors is doing a forward PE. The problem with that is you're using estimates. You don't know exactly what the company is going to be doing, but you're basically, what are you paying today versus the expected earnings, the earnings expectation over the next 12 months. And that's what we're seeing here. We're down around 21 times, and this is the lowest we've been since the 2022 low for Microsoft. So when we talk about how much some of these technology names have been devalued here, we came from one of the highest valuations we've been, 35, 36 times forward earnings last August, to now down to 21 times. So that's a huge change. And this is down at the lowest levels we've seen in terms of valuations going back to, honestly, going back to like the mid 20 teens. So, a lot of names like Microsoft have had a significant pullback already. They're getting down to the point where if you're more of a value-oriented investor, you could probably make an argument on valuations that these charts are, or that these stocks are worthy of a shot. Do the charts really scream great opportunity yet? I would argue not yet. Microsoft has a compelling potential double bottom to think about, but valuation-wise, certainly I get the argument. Getting back to some broad market stuff, then we'll get to some individual names here to finish off the live stream. Breadth was pretty good today, right? On the New York Composite Index, which is that top line, I would argue the most important one to look at. 79% advancers versus 20% decliners. On the S&P 500, even better, around 84% of that index was up. You can see all across the cap tiers, pretty consistent. So, most stocks were up, right? Almost 90% of the mid-cap index was up today. So this is a pretty good update. Is it enough to make that Zweig breadth thrust buy signal yet? No. We'll look at that chart here in a minute, because as promised, I'll keep an eye on it for you, but not quite there. But breadth days like today, strong breadth, strong surges higher certainly helps. We talked about how, for a breadth thrust to emerge, which means really negative breadth that turns into really positive breadth in a short period of time, we had to see a dramatic improvement and some huge up days. Today is an example of the kind of update you need to see. So more of that as the week progresses could potentially trigger that bullish macro signal. We'll get to that chart a little bit later. Big story today, of course, is the recovery in technology. And I would say all of the Magnificent Seven stocks feeling the love today. Meta at the top of the list, up 6.7%. NVIDIA and Broadcom, these are perfect examples of the breakdown in the AI trade, bouncing higher, both up about 5.5% today. Alphabet up another 5% today as well. Charts like Tesla, which we just highlighted as breaking down through their key support levels in the form of Tesla breaking down through the 200-day moving average. Nice bounce higher, up 4.6%. I mean, if you look at just a little preview chart of Tesla, though, right? Is this chart good yet? No, I would say it's hard to argue a technical justification for this being a good chart just yet. This is a chart making a clear pattern of lower highs and lower lows. And what you have to remember is when you're making a pattern of lower highs and lower lows, to get from the newest lowest low to the next lower high, you do have to go up. So we're going to have these upswings. This is why I think it really helps to take a deep breath, take a big step back, and really reflect, has the trend changed? One day, impressive move for Tesla. Has the trend changed in Tesla? No way. Not even close, right? Could it change eventually? For sure. And more days like this could end up turning into a broader trend change, but not enough yet. Apple up 3%. That's your worst performer in the Magnificent Seven and Friends. Microsoft up about 3% as well. So undeniably a great bounce higher in a lot of key stocks. Boy, we'll keep our eye on that as the week goes on. By the way, I did want to make a moment. D Mahler, thanks for watching live on YouTube. Said also important to note this is a holiday week and volume was low today. So thanks for mentioning that. Volume on some stocks not bad, but you're right. Generally speaking, the general holiday week playbook is as such. Two things that I've tended to find. The market tends to be generally higher, right? That's pretty consistent with any holiday week I've seen, right? So we have the Friday, we have the markets closed for the Good Friday holiday. So it's a 4-day week this week. So volume tends to be lighter. Markets generally tend to be flat to slightly higher, and usually slightly higher. You don't tend to have big upsurges on heavier volume. However, of course, 2026 has been a year of, one-off moments, right? I mean, just the conflict in the Middle East, how it was announced, how it's played out. I mean, just the headlines that have been coming out. I mean, it's a fire hose of volatility in terms of the headline risk. And so that is very much an unusual feature of this particular holiday week, that we have an active military, conflict in the Middle East with broad economic implications, driving crude oil prices higher. I mean, all of that I think is making this maybe an unusual holiday week, but I think you're absolutely right. I've learned generally pay not so much attention to moves. It's very easy to get really bullish because of a surge higher in a holiday week. Just remember that a lot of people are taking a break. A lot of people, it's not usually as much volume, so you take it with a grain of salt. However, again, given what's going on here, I would say the market not feeling like it's in vacation mode right about now. All right, let's look at the heat map. We'll talk about some of the key patterns that we observed today at the individual stock level, just to build on what we talked about so far. I mean, energy sort of taking a backseat today to growth sectors, which generally did quite well. Starting in the upper left corner of the heat map, there's the technology sector. As we've been talking about, right? I mean, the AI trade and the general technology trade has been struggling. We've talked about that general rotation away from growth into value. Today, a nice mean reversion with stocks like Intel and LRCX up 7+%. Western Digital up 7.5%. Now, Western Digital and Seagate both got dinged pretty good over the last week. So, I mean, they're bouncing higher, 7-8%. Have they really gained a lot of momentum from the recent sell-off? Not enough yet that I would feel really excited about. Seagate might be a really interesting chart to keep an eye on, though, as I'm thinking about it. Just want to zoom in a little bit to show this pattern here. Sorry, I'm just cleaning up the chart here. I would say Seagate featuring what we would call a coil pattern. This is a common pattern we've seen quite a bit here recently. That's where you have a pattern of, boy, I'm butchering the drawing of this pattern. Sorry. A pattern of, an uptrend is a pattern of higher highs and higher lows. A downtrend is a pattern of lower lows and lower highs. A coil pattern or a symmetrical triangle pattern is when the highs are getting lower and the lows are getting higher, or basically narrowing the range and settling into an equilibrium. So what the chart of Seagate is telling you in February and March is that Seagate's worth about $400 a share. And that was first reached back here in January. And we've basically overshot and then undershot that equilibrium, right? So think of that as the eventual level, and then think of it like a beach ball, like bouncing in a pool, right? It's kind of like going over and under and over, but it's kind of settling into the surface. and then eventually kind of settles, and that's the equilibrium. And what we're waiting for is, a big pop above the surface or a big push below the surface as the next move. So the beach ball is kind of bobbling around the surface. The surface is right around $400, and you wait to see which way we break. We've seen that coil pattern with a number of other charts here recently. We've tried to highlight those as we've observed them. But in an environment like this, where it feels like we've had a market move and now we're just waiting for confirmation, charts like STX could be interesting to see if we confirm a breakout to the upside or to the downside. One of those is going to happen here going into the month of April, most likely. So which comes first? And if charts like Seagate can resolve that pattern to the upside, that would actually be quite bullish, because that would imply to me that sort of that optimistic growth trade could come back. Maybe we get away from conflict in the Middle East. Maybe there's some resolution there. We get back to, is the economy good? Are these companies making money? Is the AI trade there? And maybe that propels this next uptrend in the bull market. The downside, though, is what concerns me more, is a very real possibility of charts like this resolving to the downside. And we've already seen that, right, with a bunch of charts like Apple and Microsoft that have already broken down these kind of patterns to the downside and experienced double tops that haven't been validated. So, TBD, we'll see what happens on the chart of Seagate, but for now, something to keep an eye on for sure. As we mentioned, just like that counter trend rally we're getting in the technology space, we're also getting nice bounces higher on charts like Caterpillar. These are stocks that were testing the lower end of the range here for the last month. Charts like Boeing that have been in serious pullback mode in the last 6 to 8 weeks. So again, nice bounce higher in all of these charts. Have I seen enough today that the chart of Boeing all of a sudden looks bullish? I would not tell you that. Is an impressive one-day bounce? It definitely is. With charts like Boeing and others, what you have to remember is, I would say, with what we've seen, right, compare what we saw now in March versus what we saw in November of last year. That initial move higher looks a lot like a counter trend rally. Getting back above the 200-day moving average often validates, all right, this is the beginning of something more significant. That's why we're watching that 200-day moving average on the S&P 500, currently around 6580-ish or something like that, I think. We'll see that chart in a minute. Charts like Boeing, for me, that means I'm giving up that first 20, 30 points for the opportunity to confirm the fact that this is a sustainable uptrend. So Boeing back above the 200-day moving average, Boeing with the RSI pushing above 50 or even 60, to me as a trend follower, that's enough where I'd be like, okay, Boeing's a decent chart I want to start considering. For now, it's bouncing off of an oversold condition, which is quite common, right? And happens a lot. Even when the larger trend is down, we'll get these bounces off or oversold conditions. So watching to see if that materializes into an improvement in momentum, an improvement in terms of regaining resistance. I think that's what I've not seen enough of yet, which is why I'm just healthy skepticism on what we saw today. Elsewhere, obviously, consumer discretionary doing quite well, particularly the biggest names, Amazon and Tesla. Again, both of those, a bounce higher off of a fairly low level. So I'm not super convinced just yet on that. What elsewhere, right? So the opposite we see in the energy sector, and I think flipping that thinking over is helpful too, right? Is the chart of Valero broken because the stock was down 1.3% today? Like, no way. We're still making higher highs and higher lows. The uptrend is still intact. So my trend following hat tells me charts like Valero are still fine. My trend following hat tells me charts like Microsoft that have been going down are not going up enough yet that I think those charts are really great technical arguments just yet. Elsewhere, I would say consumer staples not doing particularly well, and we're seeing further deterioration in some areas of that sector that have been painful. Charts like Walmart and Costco are really interesting to me right now, though, right? Because if you look at like a Walmart or a Costco, these are stocks that started to work. They pulled back a little bit. You could see the argument that this kind of results to the upside. It's not a perfect like bull flag pattern, but when I'm looking at the chart of Costco, my eyes are kind of seeing this kind of thing, right? We have like this big move higher and then this parallel pullback. We're really close to breaking above that upper boundary. We're really close to breaking back above 1,000. which is usually a pivot point to keep in mind. So that's an area of the market that is making me kind of interested here. Final comment I would make would be nice bounce in some of the miners, things like Newmont Mining, things like FCX. These are stocks that have been beaten down quite a bit because gold, silver, and related prices have been coming down. Nucor, NUE, which is a name we featured on our YouTube channel earlier this week, did a video using the Seeking Alpha platform, looking for strong dividend payers with some constructive technical setups. Nucor, ticker NUE, was one of the charts we highlighted there. You can find that video on my YouTube channel if you want to see the methodology and dig into those ideas a little bit. I think that's it for the heat map. Again, sort of a nice recovery day. I don't have a problem with big up days. I do have a problem with believing that that's the beginning of a huge recovery. I haven't seen enough of that yet, but we'll keep an eye on the evidence. So keep your eye on market misbehavior. By the way, I will be speaking at the Money Show in Hollywood, Florida, coming up next week. That is called the Money Show Masters Symposium. It's usually a bit of a smaller gathering, which I found to be pretty interesting. Better opportunity to sort of interact with some of the speakers a lot of times, which can be kind of fun. I will be giving a presentation called Using Technical Analysis to Find Emerging Leaders. I think given the fact that the market conditions have evolved so much since I set that title, I may tweak the presentation a bit to go through using technical tools, focusing on relative strength, focusing on new opportunities. You can sign up for that event at marketmisbehavior.com/money show, or just scan the QR code that you see on your screen. Yeah, thanks for noticing the picture. It's an older picture. That's pre facial hair, Dave. That's from a number of years ago. I feel like I have a sort of my side quest these days is to purge that picture. That's like one of the last times I think I've actually worn a suit. I've gotten very comfortable to going with no tie, no suit. I'm wearing jeans today. This is the new Dave look, but people love using that picture when the event calls for a more professional look. I'll try to get some better headshots in a suit so people stop using that picture, but hey, I can't control everything. All right, let's look at some charts together to finish off the live stream, shall we? We'll go rapid fire through some of these. So the S&P 500 still technically in our red area. The border there between the neutral range, the yellow light, and the bearish range, the red light, is 65.50. So for now, we have a pretty impressive counter trend bounce to 65.50. Given the fact that we've broken below the 200-day moving average, for me, that 200-day ends up being an important level to watch. So I would say for now, getting above like 66.50, which would take us back above the 200-day, that would cause me to sound a lot less bearish on these discussions that we're going to have. I would say the momentum confirming that with an RSI pushing above 50, ideally above 60, which would imply a real surge in buying power, I think would be pretty positive. Until then, I'm thinking of this as a pattern of lower highs and lower lows. It really started at the end of February when we began this downtrend pattern. Again, during this downtrend, we've had surges higher. And the last big up day we had was back here. This was at the second week in March. We had that big surge higher, and that was just after we broke down below 6,800. And then what happened is we never really materialized any gains above that breakdown level. So keeping an eye on that 65.50 to 66.50 range, that's sort of this area here. I think pretty important. Counter trend rally to that area makes a ton of sense. A break above that level, I think you probably have to reconsider thinking of this as a bearish trend anymore. But for now, that's my general way of thinking about it. Hey, don't forget, when in doubt, zoom out. When you have a breakdown and then a breakout, as we saw over the last week or so, as we have a lot of volatility, a lot of movement, looking at the monthly data can be helpful. This is the monthly chart, just recognizing the fact that this was the end of the month of March. Obviously, one of the biggest down months we've had. Last time we had a month like this was back in March of 2025. That was going into the April low. That's that point back here. Today we're basically getting down to the 12-month moving average, which is the blue moving average that you see here at the top. The longer term moving average, it just for me is just a reminder of the long-term kind of secular uptrend. This is the 60-month moving average that you see down here in red. We can see that we really haven't touched that moving average since the COVID low in 2020, really haven't broken below it in any meaningful way going back to 2010 to 2011. So we've been above this for quite some time, which really just speaks to the long-term uptrend phase. But with this month's drop, the monthly MACD giving a sell signal. Last time we had a sell signal was that 2025 correction. So again, more and more evidence speaking to this being a corrective move of some magnitude in terms of time and price. I think for now, we'll just have to keep navigating that and see what levels end up being most meaningful. In terms of the breadth condition, a nice spike today in the advanced decline data, but still 25% of the S&P members above their 50-day moving average, which means 75% still below their 50-day. The S&P's 50 days around 6640, as we can see in the top panel here. So the short-term and the long-term breadth, I would say, even with today's bounce, still remain fairly negative. I would need to see a lot more improvement in breadth indicators to think of those as anything but negative at this point. So this wide breadth thrust still not even close to giving a buy signal. Would need to happen by the end of this week or maybe into Monday of next week. The surge higher, that gray line that you might see faint in the background, that's the raw data. This wide breadth thrust actually uses the advancers on the New York Stock Exchange as a percentage of the total listings, and it actually uses a 10-day exponential moving average. So the line that is used in the indicator is this green line here. So even though we had a big spike higher in the advanced decline data, this is a 15-day, or sorry, what did I say? A 10-day exponential moving average. So that's just going to take a lot longer to get up there. We'd have to have a lot more strong up breadth days like we saw today for a chance of that Zweig breadth thrust turning positive. It is theoretically possible. We'd have to have a pretty bullish continuation after today's rally for that to be true. Volatility got a lot better. Is it good yet? No, right? Good volatility, good VIX, meaning, sort of a classic bullish configuration would be the VIX below 20. That's the kind of low volatility uptrend that we observed in 2025 for most of that year. Sort of the low volatility regime we saw in December and January. Now we're in a high volatility environment with the VIX above 20. And that's been where we've been for the last 6 weeks or so. The real danger signal, which we actually got last week, was the VIX spiking above 29. And so today, moving back below 29, which is pretty encouraging. If we can hold that, that would maybe suggest less of a painful correction than some are fearing. But again, the volatility of the volatility has been pretty severe here. So I'll have to keep an eye on it for now. VIX moving back below 29, I think an important data point from today's session. I just want to look at the chart of the GLD and talk about a couple things here. First off, looking at the price itself in the top panel here. So I'm going back to that major swing low. We're thinking of this as like a basing pattern in the summer of 2025. The low of that pattern was right around 290, 291 for the GLD. We then accelerated, of course, into the peak around 510, and that happened here late January. Here we have the lower high in February. You can see that initial drop came right down to the 38.2% level. Over the last week, we've actually gotten down to the 50% retracement of that larger uptrend swing from last summer to January's peak. So 50%, the level around 400, has become the new level of support. The good news with today's rally, we're back above that 38.2% level. That's kind of a bullish way to use this Fibonacci framework. If we can hold that break above 425, I think this could be a pretty impressive rally. We're actually getting into that gap range. So holding that, I would say, important for the GLD. And if we do get any sort of downside rotation, 400, given the Fibonacci level, 50% level, also that swing low over the last 2 weeks, becomes pretty important. A stronger up move on stronger momentum is pretty important. That's what's happened with a lot of these charts. The RSI has gone from bullish to neutral and now neutral to bearish. So we need to see the RSI push above 60 on a rally to really suggest positive momentum. We haven't seen that now in a couple months. Here's the chart of Bitcoin. And again, Bitcoin and Ethereum up today, not nearly to the euphoric degree that we saw with the S&P 500 and the NASDAQ. So cryptocurrencies up, but not big up in the way we saw from equities. And what concerns me right now is what we're seeing in February and March looks a lot like what we saw in November, December, January. That was a bear flag pattern that resolved to the downside. We're actually in the process of testing that lower boundary here over the last week. And I think if that can hold, that would be pretty encouraging. But if not, that's where this chart all of a sudden looks pretty bad. Remember that failure through that pattern really ended up leading to an acceleration into a February low around 60,000. Failure to hold the lower end of that bear flag could be pretty negative. The momentum is actually neutral right now, which is encouraging. But again, we're actively testing the lower boundary of that bear flag pattern. In my conversation earlier today with Ross Mayfield of Baird, and again, we'll get that episode out to you as soon as we can. You can follow the latest interviews of the Market Misbehavior podcast on our YouTube channel and all the podcasting platforms as well. But one of the things we talked about was offense versus defense. And he mentioned the work of Chris Ferrone and Todd Sohn, who are the technical analysts at Strategas Securities based in New York. Those guys are awesome. And one of the charts they've highlighted is the chart of offense versus defense. I've been a fan of this ratio myself and have used it often. So I'm a fan that they are using it as well. Offense over defense is a way of just looking at bets on consumer discretionary, things you want, versus consumer staples, things you need. And when the market gets defensive, things you need start to outperform, which means this ratio goes down. And we're looking at the equal weighted aversion in the bottom panel, which I think is the most important one to watch. That offense to defense ratio broke down going into the end of last week with Thursday and Friday's sell-off. It actually made a new 3-month low. Today, ripping back to the upside. That ratio might be an important one to watch because a recovery, particularly in the equal weighted ratio, would mean investors are rotating even more back into consumer discretionary. That could be a good all clear sign if you're thinking about what might convince you that this market is in a recovery mode, something to watch. A couple other individual stocks to highlight. Just want to point out the fact that we talked about yesterday how Apple had closed below its 200-day moving average for the first time in many, many moons. Today, bouncing back above it. So for now, looks like a compelling reversal off the 200-day moving average. I would like to see that 200-day hold because if Apple fails to hold the 200-day, it's obviously not a good sign. The real level here, I think, is around 242. That's the January swing low. That's a 38.2% level. A break below that would mean a break below the 200-day and a break below what we call a confluence of support. On semiconductor is an example of what's happened in the semiconductor space. Nice bounces off of support here as well. On is bouncing off the 61.8% retracement, also the 200-day moving average. Is this a great chart yet? No, I would say this keeps the chart at a neutral footing. We're currently in moving average limbo. We're between the 50-day and the 200-day. We're also in Fibonacci limbo between the 38.2% level and the 61.8% level. Similar to one of the previous charts we looked at, I think Seagate Technology with the coil pattern, this is kind of a similar vibe, right? We're right below a confluence of resistance. We're right above a confluence of support. One of these is going to break. I think ON might be an important chart to watch to see if that AI trade, that chip trade, is going to recover. Wanted to highlight CF Industries as one final chart to reflect on, noting a bearish divergence here. We did make a new 52-week high yesterday. That's a doji candle, meaning the open and close are almost identical, and it comes on weaker momentum. We're overbought in mid-March. We're making a new high this week, but on weaker momentum. Higher highs on weaker momentum often indicates an exhaustion of buyers. We're still holding moving average support, so not a bad chart just yet, but a bit of a warning sign. If we've been riding that higher, maybe we hold off a bit and see what happens to that momentum. All right, let's take a couple different questions here. A number of comments about Bitcoin. I see one comment saying, I think Bitcoin tracks the market risk-taking sentiment. I see another conflicting comment. I don't think Bitcoin's issues are directly related to market conditions. It's a tough one. I mean, I think the reality is, I would say the correlation between stocks and cryptocurrencies have broken down a bit. There have been a lot of times in recent years where stocks and Bitcoin have been strongly positively correlated, meaning when one moves up, the other does as well. That's kind of become disconnected here, and we're seeing a disagreement, right? And we saw that particularly where, Bitcoin broke down well before the S&P. It almost felt like a leading indicator in some ways. So how optimistic do we want to be if Bitcoin's not really recovering at this point? That, I think, is the point you're kind of making there. And that's something I think I would probably agree with as well. There may be some other things going on there, but But for now, I'm really not getting a big warm and fuzzy feeling. I mean, think about how optimistic we could be if Bitcoin was like surging to the upside as the S&P and the Nasdaq were kind of backing and filling. That would be a pretty bullish, maybe a bullish setup. I'm not necessarily seeing that just yet. Folks, that's it for now. I don't see any further questions that I want to take right now. So the remainder I'm going to be putting into the market misbehavior, the chart this mailbag. We will have a mailbag episode planned for this Friday. The market's going to be closed Friday. We'll plan to do an all mailbag episode just to get some answer some of the great questions coming in this week. If you're watching the replay on our YouTube channel, just use the comment section below the video to drop your questions there. We'd love to hear from you, and hopefully we can answer one of your questions on Friday's episode. For now, I'll say have a wonderful evening. Thanks so much for joining me today. And remember, it's always a good time to own good charts. Take care, folks.